Good afternoon. Today, the price of oil fell about 8% because two governments stopped shooting at each other for 3 consecutive nights. Airlines rallied. Stock futures rallied. The 10-year Treasury yield came in 4 basis points as the inflation scare eased. And gold, which is supposed to fall when the world calms down, went up. That last one is the whole issue. The market priced a pause as a peace. Nothing structural actually changed. The Strait of Hormuz is still effectively closed. The ceasefire memorandum expires on August 16th with all 14 concessions undiscussed. And America's emergency oil reserve just printed its lowest level since March of 1983. The risk premium left the price a great deal faster than the risk left the water. Let's take it in order. Here is the board. The S&P 500 closed Friday at 7,411, and its futures opened today up about 0.9%. Dow futures were up 1.25%, Nasdaq 100 futures up 1.17%. Brent crude sits near $90.28, down somewhere between 6.7 and 8.2%, depending on your reference price. With West Texas crude near $83.30, a one-week low. The 10-year Treasury yield eased to 4.64%. Bitcoin reclaimed 65,000, near 65,360, and Ether outperformed it, up more than 3% near 1,950. Volatility at 18, not panic, but not complacency either. And then there is gold, $4,077 an ounce, up 0.6%. Pushing toward 4,100, on the exact day the market decided the inflation risk was cancelled. Every line on that board says risk on, except that one. Hold on to it. First read, consensus says the Iran risk is over, so buy the airlines. The tell says almost nothing has been resolved. Reporting out of the Gulf is that nearly all merchant traffic crossing the Strait of Hormuz still uses the route Iran designates, which means Iran still controls the lane it supposedly stopped contesting. Transit remains, in the words of one desk covering it, pretty much paralyzed. The ceasefire memorandum expires on August 16th. The 14 concessions on the table, nuclear frozen assets, oil sanctions, are not being discussed at all. And the buffer the United States would need to absorb a re-escalation is now 311.4 million barrels, which we will come back to. Here is the asymmetry that matters. Denying access to a waterway is cheap. Guaranteeing access to one is extraordinarily expensive. A pause tells you something about intent. It tells you nothing about capacity. High conviction on that one. Second read, and it is the sharpest thing on the tape today. Nvidia is in talks to backstop roughly $250 billion of financing for a 10-gigawatt artificial intelligence campus in Piketon, Ohio, built on a decommissioned uranium enrichment site. Consensus says this is the strongest balance sheet in technology, de-risking the largest build in history, so the banks will follow and the project moves. The tell is in the perimeter of the guarantee. That $250 billion covers the leases and the construction. The chips, the part Nvidia actually sells, reportedly as much as $350 billion worth, sit outside it in a separate negotiation. If you genuinely believed the economics of the campus worked, you would guarantee the whole stack. Guaranteeing the landlord's paper while keeping your own product outside the wrapper is a specific choice, and choices like that are made for reasons. And note why a guarantee is needed at all. It is not modesty. It is that the customer is not profitable and cannot carry an investment-grade credit rating on its own. To be precise and fair, these talks are early and could collapse, and Nvidia's stated position is that it does not contractually require anyone to spend its financing on Nvidia equipment. High conviction on the structure. No call on whether the deal closes. Third read. China's biggest memory chip maker, CXMT, closed up 466% on its first day of trading in Shanghai at a market value near $485 billion, making it the most valuable company listed on the mainland. Consensus calls this chip nationalism, a patriotic bid. Ignore the multiple. The tell is in the prospectus. Company held 7.67% of the global memory market on fourth quarter sales, and its filing contains no high-bandwidth memory program at all, so it is not being priced as an artificial intelligence memory champion. It is being priced as the residual supplier in a market where the leaders moved their capacity to high-bandwidth memory for artificial intelligence servers and left ordinary server memory short. That is a shortage trade wearing a flag. And the nationalism story did land the same day, from a different direction. There are reports, and I want to flag these are single-sourced, that China has begun mass-producing its own deep ultraviolet chip-making tools, 5 machines this year, 20 by 2027. A SML and the American equipment names fell on it. That is the market pricing the second-order effect correctly, and it is the more important of the two headlines, medium to high conviction. Now follow the money, because for a month everything has run through one variable. Oil sets the Federal Reserve. Brent's push above $100 last week was never really a commodity story. It was a rates story. It dragged the 10-year Treasury to 4.69% on straightforward inflation arithmetic, and it pulled September rate hike expectations up toward 82%. Today it reversed. Brent near 90, the 10-year at 4.64. And the meeting that starts tomorrow is priced around 65% for a hold at 3.5 to 3.75%. That is an enormous round trip in 5 sessions. And what it really means is that the Federal Reserve's July decision was effectively outsourced to a shipping lane in the Persian Gulf. Chair Kevin Warsh, running only his second meeting and running it without traditional forward guidance, now gets to write language into a tape that has already made up its mind. Which brings us to the descent. The dollar softened, with the euro near 113.79, and gold rose to about $4,077 an ounce on the day the inflation scare was supposedly cancelled. Think about what that requires. Gold's two main drivers, oil-led inflation and hard interest rates, both eased today, and it went up anyway. That is a market publicly announcing it no longer needs a hedge while quietly refusing to sell one. The oil market and the gold market are not telling the same story right now, and only one of them can be right. On sentiment, across market and social sentiment monitoring today, the conversation split 3 ways, and the split is informative. The loudest cluster is the peace trade itself, and it is overwhelmingly relief. The second is the financing question around artificial intelligence, which stopped being a niche debate the moment a chip maker began guaranteeing a customer's real estate. That conversation is genuinely two-sided. One side reads a backstop as confidence that gets projects built. The other reads a backstop as the thing you need precisely because the debt market said no. Both of those are defensible, and it is worth noticing that neither side has evidence yet. The third cluster is energy security, driven by the state of the American Emergency Reserve, and it is mostly political, which is why we are going to take the one number out of it that is checkable and leave the rest alone. Common thread across all three. Everybody has a strong opinion about a fact pattern that will not resolve for weeks. That brings us to the tell, and it is not a price. It is an inventory. The United States Strategic Petroleum Reserve stood at 311.4 million barrels as of July 17th. It was 415.4 million in March. That is a decline of 104 million barrels in about 17 weeks, inside a deliberate 172 million barrel release announced in March to counter the war disruption. 311.4 million barrels is the lowest level since March of 1983. Total American oil inventories, commercial and strategic together, hit 726.2 million barrels, the lowest since 1984. So here is the fact underneath all of today's optimism. The country spent roughly a quarter of its emergency energy buffer defending freedom of navigation through a strait that is, as of tonight, still not freely navigable. Every other number today is interpretation. This one is just counting. And refilling a quarter of a national reserve is a multi-year structural bid under crude that almost nobody is modeling, because the market is pricing the consumption of that buffer as though the buffer were free. Sectors in play, energy and transport. The bull case is that the entire inflation impulse eased in a single session and the airlines got the cleanest read-through. The bear case is that mines, blockades and insurance markets are physical, while a pause is a decision. The read is that the cheapest optionality on the board is now re-escalation, precisely because the crowd just stopped paying for it. Semiconductors and memory. The bull case is that CXMT's debut confirms the memory shortage is real and repriceable. The bear case is that the shortage is being solved by the exact competitor the export control regime was designed to contain, and that the tooling constraint appears to be loosening. The read there is one line: long the shortage, short the moat. And banks. The S&P 500 Banks Index printed a record high today. The bull case is a resilient credit picture. The bear case is that a record high going into a Federal Reserve meeting that carries a live 35% hike tail is a positioning statement, not an analytical one. On the radar, Wednesday at 2 p.m. Eastern, the Federal Reserve decision and Chair Warsh's press conference. A hold is roughly 65% priced, so the entire risk sits in that 35% hike tail and in the dissents, which will tell you more than the outcome does. Wednesday also brings Microsoft and Meta, and Thursday brings Apple and Amazon. That is 4 of the 7 largest companies in the market reporting in 48 hours. Against a capital spending justification bar that Alphabet just failed by falling on strong cloud numbers. This week also brings the 2 big incumbent memory makers, and you should read them directly against CXMT's debut, because if the shortage is real, their guidance has to say so. Thursday, the Bank of England, where a hold is expected and the hawkish dissent is the story. Then August 10th, the hard Senate deadline for the Clarity Act on digital assets, with 7 votes still needed. And August 16th, the expiry of the Iran memorandum, which is the actual event this entire tape is trading around. One honest indicator for that last one: watch shipping insurance rates in the Gulf, not the oil price. The scorecard, first, grading what is already on the board. Yesterday's call that the oil risk premium was not fully unwound went live and got stress-tested immediately. The falsification threshold was a Brent close below $88 before August 15th, with Hormuz still impaired. Brent traded near $90.28 today, close to the line but not through it. The positioning call and the Clarity Act call are both still live and untested. The semiconductor call, that the re-rate is a multiple event rather than a demand event, got quiet support today from 2 directions at once. Now 4 new falsifiable calls dated today. 1. The oil risk premium is underpriced, not overpriced. Brent does not sustain below $90 through the August 16th expiry while transit stays impaired. Falsified if Brent closes below $88 for 5 consecutive sessions before August 16th. 2. The chip perimeter is load-bearing. Any final structure keeps chip purchases outside the lease guarantee. Falsified if a signed agreement guarantees the chips on the same terms as the leases. 3. CXMT's re-rating is a shortage event, not a technology parity event. Falsified if the company announces a high-bandwidth memory production program funded by these proceeds before the end of the year. And 4. Refilling the Strategic Petroleum Reserve becomes stated American policy before December 31st. Falsified if no official refill program or solicitation is announced by then. And the close, the market spent today buying airlines. It spent the same day bidding gold. Those 2 trades do not believe the same story, and one of them is lying. So here is the question worth sitting with tonight. If the pause were really a piece, why is the safest asset on the board still going up? And why is the buffer that would absorb the alternative sitting at a 43-year low? We will be watching Wednesday's language, Thursday's capital spending numbers, and shipping insurance rates in the Gulf, which will tell you whether the strait reopened long before the oil price does. This has been the Asymmetric Daily Brief. Research and educational content only. Nothing here is personalized investment advice. The asymmetric signal, one contrarian read a day. Subscribe.